Here's a question that keeps millions of investors awake at night. Should you put your money into real estate or just dump it all into index funds? I'm talking about life-changing money here. The difference between these two strategies over 20 years could literally be hundreds of thousands of dollars. So, let's settle this debate once and for all with actual numbers, real examples, and zero BS. By the end of this video, you'll know exactly which path leads to more wealth and which one fits your lifestyle. Let's dive in. The great real estate versus index funds debate isn't just about returns. It's about completely different approaches to building wealth. Real estate gives you tangible assets you can see and touch. You collect rent checks every month, and over time, your property appreciates in value. It's like having a money printing machine in your backyard. Index funds, on the other hand, are pure simplicity. You buy a piece of thousands of companies with one purchase. No dealing with tenants, no maintenance calls at 2 a.m., just set it and forget it wealth building. But here's what most people get wrong about this comparison. They look at average returns and think that's the whole story. The reality is much more complex, and the devil is in the details. Let me show you what I mean. Let's start with real estate returns. The average home in the United States has appreciated about 3.8% annually over the past 50 years. But wait, that's just appreciation. Real estate investors don't just rely on property value increases. They also collect rental income, which typically yields 6 to 12% annually on your invested capital. So your total return might be 10 to 15% per year. Sounds amazing, right? Hold on. We need to factor in the real costs that most people conveniently ignore. Property taxes, insurance, maintenance, vacancy periods, property management fees, and the occasional nightmare tenant who destroys your property. These costs can easily eat up 30 to 50% of your rental income. Suddenly, that 15% return looks more like 8 to 10%. Now let's talk about index funds. The S&P 500 has averaged about 10% annual returns over the past 90 years. And here's the beautiful part. That's your net return after accounting for the tiny expense ratios of most index funds. No hidden costs, no surprise maintenance bills, no dealing with people. Just pure compound growth working for you 24/7. But there's another factor most people miss: leverage. With real estate, you can put down 20% and control a $500,000 property with just $100,000. If that property appreciates 5%, you've made $25,000 on your $100,000 investment. That's a 25% return on your actual cash invested. This leverage effect can supercharge your returns, but it also amplifies your risks. If property values drop, you could lose more than you invested. Index funds don't typically offer this leverage advantage for regular investors. Let's run some real numbers. Imagine you have $100,000 to invest. Scenario 1, real estate. You buy a $500,000 rental property with 20% down. After all expenses, you net 8% annually on your $100,000 investment. Plus, the property appreciates at 4% per year. Your total annual return is roughly 12% on your invested capital. After 20 years, assuming you reinvest all profits, you could have around $964,000. Scenario 2, index funds. You invest that same $100,000 in a low-cost S&P 500 index fund averaging 10% annually. After 20 years, you'd have about $673,000. Wait, real estate won? Not so fast. I made some generous assumptions for real estate. I assumed you found a great property, had minimal vacancy, never had major repairs, and could consistently reinvest your profits into more properties. In reality, real estate returns vary wildly based on location, timing, and your skill as an investor. But here's where index funds really shine: simplicity and consistency. While real estate investors are dealing with burst pipes and difficult tenants, index fund investors are literally doing nothing and watching their wealth grow. The time value alone is worth considering. Think about it this way. If you're spending 10 hours a week managing rental properties and you value your time at $50 an hour, that's $26,000 per year in opportunity cost. Factor that into your returns, and suddenly index funds look a lot more attractive. There's also the liquidity factor. Need money quickly? You can sell index fund shares in seconds. With real estate, you might wait months to find a buyer, and you'll pay 6% in realtor commissions plus other closing costs. Now let's talk about the psychological aspects that nobody discusses. Real estate feels more real because you can drive by your investment. This tangibility can be comforting, but it can also lead to emotional decision-making. You might hold on to a poorly performing property too long because you're emotionally attached. Index funds remove emotion from the equation. The market goes up, the market goes down, but you're not making impulsive decisions based on your feelings about a specific property. Here's another consideration: diversification. When you buy a rental property, you're betting on one specific location and property type. If that neighborhood declines, or if there's an economic downturn that particularly affects your area, your investment could suffer significantly. Index funds give you instant diversification across thousands of companies and sectors. If tech stocks crash, maybe healthcare stocks rise. Your investment is spread across the entire economy. But real estate has one massive advantage that's hard to quantify: forced savings. When you have a mortgage, you're essentially forcing yourself to save money every month through principal payments. Many people struggle with the discipline to consistently invest in index funds, but they'll never miss a mortgage payment. Let's address the tax implications, because this is where things get interesting. Real estate offers significant tax advantages through depreciation deductions, even if your property is actually appreciating in value. You can also do 1031 exchanges to defer capital gains taxes when you sell properties. Index funds are taxed as capital gains when you sell, but if you hold them for over a year, you get favorable long-term capital gains treatment. Plus, many index funds are tax efficient, generating minimal taxable distributions while you hold them. So which builds more wealth? The honest answer is, it depends on you. If you enjoy being hands-on, have time to dedicate to property management, and can handle the occasional crisis, real estate might offer higher returns. The leverage and tax advantages can be powerful wealth-building tools. But if you value simplicity, want true passive investing, or don't have time to be a landlord, index funds are probably your better bet. The consistency and compound growth are hard to beat, and you'll actually sleep well at night. Here's my personal take. For most people, index funds are the better choice. They're simpler, more liquid, truly passive, and historically reliable. Start there. Build your foundation, and once you have a solid base of index fund investments, then consider adding real estate for diversification. Remember, this isn't an all-or-nothing decision. You can do both. Many successful investors use a mix of index funds for simplicity and real estate for diversification and additional income streams. The key is understanding your goals, risk tolerance, and how much time you want to dedicate to your investments. Whatever you choose, the most important thing is to start investing consistently. Time in the market beats timing the market, whether you're talking about real estate or index funds. What's your take? Are you team real estate or team index funds? Let me know in the comments below, and if this breakdown helped you make sense of these investment options, hit that like button and subscribe for more no-nonsense investing content. Your future wealthy self will thank you.